if you are age 55 and you leave your job in the year which you turn 55 or older, you are exempt from the 10% penalty for the account that is affiliated with that job. This doesn't apply to IRAs, and this doesn't apply to a 401k that you have from another employer. So just be careful about that. You can't go to your old 401k and take a distribution and be like, hey, I'm 55, I'm peace out, I'm leaving. You have to understand that it only applies to that particular related account that you have at your employer. If you're a qualified public safety employee, guess what? You can retire early. 50, it goes that age, that 10% exemption goes down from 55 to 50. Or if you reach the age of 55, or excuse me, here's the other one. Let me take a step back. There's a 72T election, which I don't know if Scott has necessarily covered yet. I've heard it mentioned, but there is an ability for you to be exempt from a 10% penalty and retire and take distributions earlier than 55, but you have to understand the caveats that are attributed with it. You have to take payments for at least 5 years or until you reach age 59 and a half, whichever is longer. So if you're 53 and you start taking these, substantially equal periodic payments, they don't stop. You can change the way that it's calculated once, but if you take it at 53, you have to wait till 59 to stop. You can't just turn it on, turn it off whenever you feel like it. Once it's going, it's just going. So you have to be aware of that before you make that election. Roth accounts. One thing that people typically understand is, yeah, tax-free income, awesome, but there are some rules attributed to it. In order for it to be totally tax-free, the account has to be open for 5 years and you have to be age 59 and a half. If you are not age 59 and a half or you haven't met the 5-year mark, you can take out your contributions tax-free, but the earnings attributed to that are taxable and are eligible for the 10% penalty. So just be aware of that when you're thinking about taking money out of your Roth IRA. This also applies to other Roth accounts other Roth accounts like the 457, the Roth 457, or the Roth 403B, and the age 55 rule does apply to that. You are exempt for the 10% penalty. Roth Ira rules, where I typically see people get kind of confused is, like I said earlier, you must be 59 and a half and the account must be open for 5 years from the day of your first contribution. But if you are doing Roth contributions, including backdoor, which I believe Scott's going to tackle at some point coming down the pipe, you have your own 5-year clock for each conversion or backdoor Roth conversion. So if you do it periodically throughout the years, every time you do it, you have a new 5-year window that you need to be aware of. So if you're going to be doing these kind of strategies, do it earlier rather than later, especially when you're getting closer to the age of retirement. So to add to this, this is going to be a couple slides, so I apologize in advance. But in terms of your tax efficient strategies, it really just depends on how your distributions are going to be taxed, right? If you have pre-tax retirement vehicles, it's ordinary income tax. Pensions are usually ordinary income tax. However, I have seen Roth contributions to some pensions, but that's incredibly rare. So the taxable amount may be a little bit different. Your Roth accounts with qualified withdrawals are tax-free. So even though you get a 1099-R, which reports the distribution, which you have to report on your tax return, it's not taxable to you. So just be aware of that, assuming that you've met the 59 and a half and the 5-year mark. HSAs, which is a great vehicle, it's almost like a cheat code. If you have a ton of medical expenses and you don't reimburse it in this year, guess what? You could wait till you're age 65 and you could totally reimburse yourself for all those expenses that you had 30 years ago. And it's totally okay. There's no rule that prevents that. So if you have the ability to pay your expenses out of pocket and allow your HSA to be invested because you're getting that triple tax benefit of tax deferral within the account, the earnings grow tax deferred, comes out tax free if you have qualified medical expenses, and also you get a tax deduction for it. So if you have the ability to kind of just pay out of pocket and let those earnings accumulate in there, you can tap that as another retirement vehicle by reimbursing yourself for those expenditures, 30 years ago. So just be aware of that cheat code that's there. I haven't heard anything that's suggesting that that's going to be removed, but who knows? Maybe when our government needs more money, they may kind of close that that loophole, or not loophole, but amend it, if you will. RMDs, requirement minimum distributions, which usually kick in around 72 now, thanks to an act that was passed last year. Those don't apply to Roth IRA accounts, excuse me. They do apply to like a Roth 401k or 403b. So if you have a Roth 4 IRA, which Dan and Scott are huge proponents of, you don't have requirement minimum distribution. So the cool thing about it is you can take income from it when you need it. You don't have to take it out every year once you hit 72, assuming that that's your retirement age. So it's a great fill in the gap type of plan where, let's say you have a pension, maybe a 403b, and you're getting this income and you're like, man, I need more. If you had the Roth IRA, you could take some money out of that, assuming that you're 59 and a half and meet the 5-year rule. That's tax-free income to you, which also plays into some other moving pieces when you get older, because there's the Medicare premium increases, for example, IRMA. I can't remember what it stands for specifically offhand, but when you hit Medicare age and you're on Medicare, if you have big fluctuations in your income, that can increase your Medicare premiums. So the Roth IRA is great because that doesn't count towards those IRMA adjustments. So if you have the ability to contribute to a Roth IRA, I strongly consider it, because it gives you some flexibility down the pipe. Withdrawals. So it really depends on your tax situation. And so I apologize for the individual who's on here that maybe wouldn't necessarily, I'm not answering it specifically, I do apologize, but it really just depends on what your tax return looks like and your overall financial plan. But a good rule of thumb that a lot of people typically see, and if you Google it, you're going to see a lot of this, is you spend your taxable account first. Let's say you just have a taxable Vanguard account and you spend all that money first, and you will allow your RMDs and all that, or your pre-tax vehicles, to continue to compound on a tax deferred basis. You spend that money until you actually need the RMDs, or you're required to start taking out the RMDs, and then you deplete those funds, and then when you need it, you have the Roth IRA to kind of on the back end. However, there are some weird disadvantages to it, and it really depends on your tax situation. But if you spend your taxable account and your IRA is huge, you are going to be taking huge distributions come retirement, which is taxed at ordinary income tax rates, which means that you're, in theory, if you're in the 24 tax bracket, just use a rule of thumb, you could be owing 24% on that, in addition to your state return, if you have a state return that you have to file. So it could backfire on you if you have a lot of deferral in there, because all of a sudden in the huge, in the, a couple years into retirement, all of a sudden your ordinary income tax or your taxes could jack up, because all of a sudden you're starting to take these huge distributions. And so just be aware of that when you're working with a financial advisor or an accountant or a combination of both. Address this with them. They will be able to walk you through this. If not, maybe something Dan and Scott and I can put something together to kind of walk through these, that maybe could be another presentation, so you guys have more resources on that. I'd be more than willing to do that. The more balanced approach is kind of use all the accounts in tandem, where you're kind of spending them all at the same rate. You do have to take ordinary income taxes and capital gains taxes into consideration, because for your taxable account, if you have to sell stocks to produce income, there could be chances that you have capital gains. Granted, if assuming that those positions have been held for a year or longer, you're going to get long-term capital gain treatment, which is qualified treatment, which is anywhere from 0 to 20%. If you hit NII tax, that's an additional 3.8. So max would be 23.8%. And so just be aware of that when you're selling stuff in your taxable account. If you have the ability to take some losses to offset those gains, I would strongly consider that, especially if you have to take a huge amount of money out to live. So that's one thing you want to be aware of. Also, the dividends and the interest that are being kicked off the investments in your taxable account are taxable every year, even if you reinvest them. A lot of people get this mistake. If you reinvest the dividends into your, I don't know, your S&P 500 index fund from Vanguard in a taxable account, great. You're putting more money into the, into that actual position that you have, but you're going to be paying taxes on it every year. So just be aware of that. Let's see. If you are fortunate to have a traditional IRA where you don't need the money, but you need to take RMDs, do a qualified charitable donation, also known as a QCD. This can be set up with your financial advisor or wherever you have that particular account. It's fantastic. You get two benefits. One, when you make that distribution and it goes to the charity is getting the money. So if you have a favorite charity that you like to support, this is a great way to get the money. The second benefit is it doesn't report as taxable income. You can have a distribution up to 100 grand a year that, as long as it goes straight from the broker to the actual organization and you don't touch it in between, you don't report that distribution as taxable income. Now, you don't get a deduction for that amount that goes to the organization, but you don't report it as income. So if you are getting towards that age where you have the IRA and you're starting to take RMDs and you don't need it, this could be a great way to benefit the charity that you have. Another way that you can focus on things is focus on tax efficient investments in taxable accounts, meaning mutual funds are notoriously known for kicking off capital gain distributions at the end of the year, right? And that's something you can't control. And you find out in December when it's too late. I would focus on other things, maybe like ETFs, exchange traded funds, something that maybe doesn't necessarily kick off all those expenditures, or excuse me, the capital gain distributions at the end of the year, and can actually kind of mitigate those tax consequences. A lot of index funds now have exchange traded fund versions of themselves. So maybe that's something that you consider in a taxable account. I strongly suggest too, that if you're really worried about tax efficient strategies for retirement distributions, plan ahead. If you are in the younger generations and you have an IRA or something along those lines, consider doing Roth conversions early. Chances are, if you're younger, you're in a lower tax bracket, so you can fill some of those buckets with some of your pre-tax vehicles when you do the Roth contribution or Roth conversions. Another thing that Scott touched on a couple of weeks ago, which I'm a huge proponent of, if you have the ability to maximize your pre-tax vehicles like a 401k, 403b, 457 plan, and you can reduce your taxable income to get within the income ranges of your Roth IRA, which I don't have offhand, unfortunately, but Roth IRA contributions are determined on income level, not if you're covered by a retirement plan. So if you can get your income low enough to be able to maximize those contributions, that's something you strongly want to take into consideration in doing, because you can have the tax diversification later down the road. If your income's too high, backdoor Roth contributions, which I think Scott's going to tackle at some point, so I'm going to leave that to him. But what you need to be aware of is, if you have multiple IRAs and you are considering doing the backdoor Roth contributions, the IRS doesn't allow you to do, hey, guess what? I'm doing this non-deductible contribution to my IRA and I'm going to immediately roll over to the Roth. IRS goes, if you have earnings and you have other IRAs, those get aggregated together and there's a pro rata allocation that you have to determine which portion is non-deductible and which portion is taxable. So they're not going to let you pick and choose. And so if you have an IRA existing and you need to do backdoor Roth contributions, and Scott brought up this good point a couple of weeks ago, if you want to take that IRA and roll it back into your employer plan to empty it out, then you can start doing the backdoor Roth contributions. So, but just keep in mind, you just want to make sure the rollovers make sense for you in your dynamic, and make sure that you're understanding fully what that entails. This one was actually this one is the first time I've ever gotten this. And so this was the new one for me. So I had to sit down and think about this. How do you know if you have a good tax person? It really depends. I'll tell you what, it's a lot easier working with clients that have a similar personality with you. Do you mesh well? You will not believe how many times political stuff comes up in the middle of conversations, and you can tell whether or not you really relate to them on that level. So if that's important to you, I would definitely try to find somebody that maybe has the same wavelength of thinking so that you feel comfortable in that environment. Referral from a friend is always a great place to start. So if you're uncertain, I would definitely reach out to somebody that maybe has a CPA or an EA, or another tax preparer to kind of help you kind of get an idea. Hey, you know, John Smith is your CPA, right? Yeah. Well, what do you like about him? Can you refer me? That's also another place to start. You can look up licenses, so you can look up EA and CPA licenses. So if you go to California and do CPA lookup, you can find me on there. Both EAs and CPAs are the most well-known licenses in the industry. Both of them have rigorous criteria that you have to meet and substantial continuing education, so we have to be informed. um, how aggressive are they, right? Some people really like to play in the gray areas. Some people don't. Some people write off anything. So you really need to be sure that you're comfortable with those gray areas or with the deductibility and the way that the preparer approaches things. How much experience do they have? Are they a new kid on the block, or they've been doing it for 30 years? Is the experience specifically what you're looking for? So if there's a CPA that specifically works with teachers, maybe that's the person you want to work with. I have nothing against H&R Block and TurboTax. Just be aware of what goes in, what comes out. And so there are good preparers, there are good reviewers at TurboTax, there are good preparers in H&R Block, but too often than not, I see a lot of mistakes that get made on those. And usually they're pretty expensive to use. I don't know how much it costs to use TurboTax software nowadays, but that's something to be aware of. Also, big no. If you think that automatic feeding into your TurboTax is going to work 100% accuracy, you are 100% wrong. Check the information. I literally just had an issue with this for a couple years ago where somebody fed from a TD Ameritrade account that didn't catch half of the transactions that were in there. They just got a letter from the IRS saying that they underreported, and now we're dealing with that. So be aware of that. Double check your numbers and your work. A bad versus good experience is kind of subjective. Personal preference is huge. If they like working with you, they're going to stick with you. Did they mess up a return? How many times have they messed up on your return? If they messed up a buttload of times, that's probably something you want to, maybe steer away from and go find somebody else. Do they respond to you ever? CPAs are notoriously known for this, and probably some EAs as well. When tax season is over, we take a hiatus. However, if you have questions that they're never responding to, that's a sign that probably they're not as engaged as you need them to be. So take that into consideration. We also work a lot of times, depending on what the engagement is, on an hourly rate. And so be aware that if you call a CPA or an enrolled agent, they may turn the clock on. Personally, for me, if I can answer the question in 5 or 10 minutes, I'm not going to charge you for it. If I need to do research, I will tell you that beforehand. And so you get to make the choice of, is my time worth it to determine this dynamic for you? So just be aware of that you may get a surprise bill, which a lot of people don't like. So that's something you definitely want to clear up with your tax preparer, or the person that you're interviewing. That's a great interview question to have. And that's it. I wanted to get through this so you guys have time to answer questions, or ask questions, excuse me. This is my contact info. The Dan at BBFS Slow right now is the best time to get a hold of me. The phone is really not the best choice. Twitter, FinTax Dude is my name. So if you ever have questions, you can find me on there as well. So I hope that wasn't too much. Again, I'm going to make this available to Dan so that he can give it to you as information. And if you have any questions, don't hesitate to ask. Okay. So that's it.
Wow. Dan, I am blown away, and I feel so good that I've been using a tax accountant over these years that I haven't tried to do this myself. I am just blown away. So here's what I think I'm going to do, folks. I'm going to put this on our YouTube channel. I think that might be the best way for you to have this information as opposed to just the slides, because I think Dan's commentary is huge. In one moment, we are going to transition to the questions that you've posted on the collaboration board.
Yep.
Real quick before we do that, I just want to show you a couple of upcoming events. One we are just super excited about. This Thursday we do our regular monthly office hours. Next week, four of the amazing women that we have been so lucky, of the many amazing people that we've met, through 403BYs, they had the idea to put on an event geared towards women. And it's called Women and Personal Finance. And we are so excited about that. That'll be a week from Thursday. And then on March 2nd, the gentleman that we had on who talked about budgeting, David Gurley, he's a teacher turned budget coach. He is doing an event on getting wise to public service loan forgiveness. And that will be on March 2nd. So I will stop sharing. Scott, you're going to manage the questions. I'm going to post our YouTube channel link. And my goal is to have this on by Saturday on that page. So you can have this entire presentation. And we do not show any other faces, but Scott, myself, and Dan in this case.
Dan, real quick,
Sure.
if there's a demand for questions that people need to ask, if you guys want, I could do an office hour where we have
Oh, okay.
an hour of questions. I realized that my presentation went long. I just wanted to cover everything that you guys maybe would deal with, and
Well,
so let me
let's
know.
do that. Well, actually, two things. Let's off air. We'll talk about in office
Sure.
hours. Will just be you and answering questions. That is so generous of you, Dan. And the
Sure.
second thing is, absolutely, we should do a separate event just on retirement plan withdrawal
Yeah.
strategies, because that is so complex and so important. So, folks, I just posted the link to the 403BY's YouTube channel. So again, that's where this presentation will live. All right, Scott, I'm going to turn it over to you and the questions. For those of you that aren't sure what we're talking about, collaboration board, we use something called Nearpod, and I'm going to do a screen share so those of you who aren't on it right now can see it.
All right.
Hit me, Scott.
All right, Dan. Thank you, Dan's. Again, thanks, Dan, for
Yeah.
that wealth of information.
Sure.
So we've got quite a few questions here. Actually, a lot of questions.
Okay.
So I'm going to try to knock out a few of the easier ones, and we can make our way towards some of the more difficult ones. So do school psychologists qualify for the educator expense tax deduction?
Oh, that's a good question. I would imagine they do, right? Because in my limited knowledge, a counselor, right, like a school counselor, if you're
Yeah.
on site and you're actually providing services to students and you're paying for stuff out of pocket, I would highly think that you would qualify for that.
Yeah, I would.
Yeah, I
too.
would. Yeah, that seems like a reasonable thing.
If married, how do you decide which is better, to file jointly or individually?
9 times out of 10, filing jointly is going to be more advantageous. If you file married filing separately, if you do that, there's a lot of things that you lose in terms of deductibility. Your income thresholds for maybe some tax credits and everything else significantly decrease. And so if you are I don't know if TurboTax, assuming that that's what you're using, has a module where you can determine whether it's more advantageous to file jointly or separately. That's something you definitely want to take a look at. Tax preparer software, assuming that they have it, can do that for you, and that's a question that you could easily ask us to do. But 9 times out of 10, jointly is going to be better for you versus separately.
All right. So educator expense. So this educator expense that is allowed.
Mhm.
I see that if there are, it doubles if you're married filing jointly. But
Yep.
does that only double if both people are teachers?
Yes.
Or okay, all right.
Yeah.
So like,
Yeah.
since I'm not a teacher, but I'm
Yes.
married to a teacher, it doesn't double for me.
No.
It only doubles if we're both teachers.
Your wife would be the only one who gets 250.
Oh man.
I know, right?
There
Heaven
goes
forbid
that.
that teachers get more of a deduction for that. I think it's outrageous.
Oh, Yeah, I know, right? They shouldn't have to bear that expense in the first place, but I agree. Okay, so I used a coronavirus-related distribution to get my funds out of a bad 403b and get them into a lower fee 457. So this is using the escape hatch that we talked about last year. Is this listed as a rollover on my taxes? So it's you get a 1099 for the money coming out, no penalty. And I guess the answer to this is going to be dependent upon what year they put it back in, whether they put it back in 2020 or if they put it back in 2021, because how that's managed is a little different.
Yeah, so this is the conundrum that we're still waiting for a pending form that's supposedly going to be given to us. So if you took the money out, but then you put it back in the same year, assuming it's 2020, let's just say, for example, they will deem that as a rollover. So you take the money out. If you get the money back in, you're rollover, penalty free, no problems. If you go over a course of years, that's where it starts getting tricky. And so what we have is a form that actually will track those contributions throughout the next 3 years ratably. And so that's an election you have to make on your return. And depending on when you contribute that money back determines whether you have to report it on the return or you have to go back and amend prior years. And so if you have that, this is probably maybe this year or maybe next year, you probably want to engage somebody like me who can actually help you walk through that, because I don't know if TurboTax is actually going to take that into consideration. I would imagine H&R Block could help you with it, but it's complex, it's convoluted. The way the regs were written are really confusing. And so I would highly suggest engaging somebody for that, especially if you didn't contribute it back in the same year.
All right, great. Thanks, Dan.
Yeah.
Does the lifetime learning credit apply if my school reimburses me the tuition cost?
You have to reduce the amount of expenses by that reimbursement. So if they reimburse you in full, you're not eligible for it.
Got it. If so, I'm not quite sure what this question is asking. So
Sure.
maybe we can answer it in a couple different ways. So if we just recently opened and funded an IRA for 2020,
Okay.
what should we do about taxes for that money? So I'm not quite sure if they mean, first of all, pre-tax or Roth, and then whether or not, yeah, I'm not quite sure, but I would assume there's going to be some tax savings if you qualify to contribute to a IRA in 2020. And that's just going to reduce your taxable income. But maybe if you're the one who asked that question, if you maybe clarify in the chat, that might help. Did you get something out of that, Dan, that might?
Yeah. So I think kind of what they're getting at is there a tax benefit to the contribution I made in 2020? So that's going to depend. Roth IRA, strictly after tax, no tax benefit, but you still report the contribution on the return. If it's a traditional IRA and you're covered by a qualified retirement plan, like a 403B, for example, there is a threshold of an income where you can still get that deduction. And so if you are within that threshold, depending if you're filing jointly or single, there's going to be phased out. If you're above it, you're not going to get any tax benefit from it. And so that's something where I'm assuming that's what you're getting at.
Actually, Dan, so we got a little bit of clarification. So it's actually, are they going to get a tax form for it? So if you didn't make your IRA contribution for 2020 until 2021, are you going to get something from the mutual fund company or the brokerage firm saying that you made that contribution for 2020, for the year 2020, if you made it after the year 2020?
Sure. So that's usually what's called a Form 5498, and that reports the contributions for the year. The problem with those is they come out in weird parts of the year. And so a lot of times you get them in May. So if you made a contribution and you're seeing a tax preparer, I would make note of what kind of contribution you made so that they can report it on your return. You don't necessarily need that form to confirm it, but you want to report that on your actual return, whether it's traditional or it's Roth.
Perfect. If we've been conducting our classes from home this year, I've heard this question a lot. Can we write off our classroom, quote unquote classroom, like a self-employed person can write off a home office? I think you're not going to like the answer to this question.
No. And that's been one of the biggest frustrations with a lot of people working from home is like, how come I don't get to write this off? Right. And so, um, as an employee, if you had a home office, you way back when 2017, you were able to take a deduction as a unreimbursed employee expense subject to 2%, assuming that you itemize. And so that's now gone for federal purposes. However, if you do itemize and you do have a home office and your state return doesn't conform, you could get a benefit on the state return, but that's really dependent on state. And I didn't want to go over states because I don't know 50 different tax codes. And so, but just be prepared that that may be something where if you are engaged a preparer, ask them that, because if your state doesn't conform to federal, you could get benefit from it. So that could be a portion of your rent, your utilities, anything like that. And so if you do, and if your preparer gives you an organizer, write it on there as a question.
All right. I've got another 1099 question that I don't think think they're going to like the answer on.
Sure.
I'm on a state committee for a nonprofit student organization.
Mm-hmm.
It's a paid position, so they receive a 1099. TurboTax says I need to pay self-employment tax. Since I have had this position more than 2 years, should I have to pay self-employment tax on this income?
I think it depends on the engagement of how you're actually engaged in the nonprofit. If you're an independent contractor and they just pay you contract work and you've been doing it for the last couple of years, there's a good chance you have to pay self-employment income. I have seen 1099s done incorrectly, so there is a chance that maybe that income could be other income, which you wouldn't be subject to self-employment tax. But if you are literally an independent contractor and you work for this nonprofit and maybe you work for some other ones, good chances that it's a profit motive, in which case you would owe SC tax on it. But the cool thing about that is if you have expenses related to it, you can deduct those. And so just be aware of that. And if you have more expenses than income, assuming that you haven't had losses for the last couple of years, you could take that loss. So just be aware of that.
Okay, very good. Okay, here's an easy one. This no dumb questions, but they preface it? This may be a dumb question. It's not a dumb
never
question.
a dumb question. No.
Well, actually, there is one dumb question on here, but it's making fun of me, so that's why. So this may be a dumb question, but does the 1099 form come in the mail like a W-2 would? How do I know when to make? Oh, so it's two questions. And how do I know when to make quarterly payments?
Sure. So yes, the 1099 should be mailed to you by their employer, unless the employer is tech savvy where they could email it to you. So they do have software that does that. So if they are emailing it to you, make sure it doesn't go in your junk folder. Estimated tax payments. Usually if your tax liability is over $1,000, both federal and state, if you have a state filing, you will have to start paying estimates. So just be aware of that. Usually what happens is if you have a higher tax liability than $1,000, your software will start generating 1040 ES, which are your estimated tax payment vouchers. And so it will automatically do that for you. If not, work with somebody to get them to you, because underpayment penalties and interest are no bueno. Those people despise. They will hit you with those too if you're not paying enough throughout the year.
Is there a quick and easy way to determine AGI versus MAGI, modified adjusted gross income?
Oh,
this is tough because there's different types of modified adjusted.
Yes, and so a good rule of thumb is that if your return is very straightforward, you could probably use AGI as your ballpark to kind of figure out. So if you're trying to figure out if you can do a Roth contribution for 2020, you could probably use your AGI and be okay. If you have a lot of moving pieces, that's where stuff starts getting added back. And so that's where, the back of the napkin probably wouldn't work. So simple, straightforward. All you have maybe is a W-2, try and do a Roth IRA. You can use AGI.
Perhaps my favorite question here. Will the teacher who knitted the gloves Bernie Sanders wore to the inauguration be taxed?
God, I hope not. Wait, did she sell those? Did he buy those from somebody? Sorry, I don't know the story.
No, she sent them to him, but yeah, I don't know if she has made a business out of it. So I mean, it would depend on if she made a business out of it and is making profits on a regular basis, or if it's just a hobby.
Yeah.
And every so often she gets paid. So I think the answer is probably no.
No, I mean, if she was a good Samaritan and she just sent it to Bernie and said, "Thank you so much for being Bernie," you don't have to worry about it.
Right. If I purchased a vehicle to get to work
Okay.
as a school psychologist,
Okay.
that I equipped with mobility equipment, can I deduct the expense of the vehicle?
So here's the fun part. So, assuming that you are okay, well, there's there's two different ways this can go. 9 times out of 10, a mileage deduction is going to be more advantageous for any vehicle. So even if you bought a vehicle and you're keeping track of all your ordinary expenses, mileage reimbursement is going to be, or deduction is going to be more advantageous because it's about 57.5 cents per mile. So you want to track your mileage when you start having a vehicle for your business. The dynamic of when does mileage become deductible mileage is tricky. If you have a home office and you're driving to temporary job sites, meaning you don't have an office somewhere else, the mileage from your home office to the job site is deductible. However, if you don't have a home office, or if you do and you have another office where you primarily do your business or your meetings, the drive from home to your office is commuting. And so that's not deductible. But if you drive from your office to other job sites, that's deductible. But the expenses for mobility purposes, it could be. It really just depends on what specifically it is, how it's attributed to your business, and how much it is, because it could also become a fixed asset for you for your business, and that's a whole different realm. And so that's something where if it's above $1,000, I'm assuming it's probably expensive. That may become a fixed asset for you, in which case you get depreciation over a course of so many years, but it really just depends on the price. If it's like only $500, I would just write it off in full. Just call it like a supply or something. But you know, it really just depends on how much you spend and what exactly it's for.
Okay. When you take a withdrawal from a retirement account, how do you tell the IRS which dollars you are taking? In other words, how do you tell the IRS that you're taking contributions from a Roth IRA, not growth, so there isn't a penalty? Oh, okay.
Yeah. So the fortunate thing about the Roth IRA is you can take the contributions out first. So anything, if you haven't met the 59.5 and the 5-year rule, you can take contributions out first. Once those become exhausted, the rest of it's earnings. And so that's taxable. If you met the 59.5 and the 5-year rule, all of it's tax free. So you don't have to worry about it. What happens is that you get a 1099-R at the end of the year that reports it. And depending on how it's tracked, it should tell you whether it's taxable or not. If you take an early distribution where you don't meet the 59.5 5-year rule, there's a good chance it's going to tell you that you're taking out contributions. But if you've exceeded those, then it'll tell you what the taxable amount is of the distribution. So it's all predicated on that form that you get for your distribution at the end of the year.
Yeah. And on IRA accounts where you've only made, where it's an account where you've made contributions to it throughout time, it's automatically first in, first out, meaning for contributions in, they will automatically put that on your form. It gets more complicated when you have conversions and rollovers and stuff. But
yeah.
Let's see, I know we're running out of time here, so I want to make sure we get questions that everybody can benefit from. And is Scott's orange shirt deductible? That is not one of them.
It's a nice V-neck though, man.
Okay. Thoughts on H&R Block software versus TaxAct and TurboTax?
Oh,
I know you use your own software and not others. So,
I think it really depends on what you have in your overall tax situation, right? If you're a straight W-2 and maybe you have a contribution to retirement account, maybe a taxable account, whatever, They're all roughly the same. They just do things different ways. Once you start getting more complex, though, like let's say with the sole proprietorship, if you're an SLP or something along those lines, that's where you can start seeing it kind of falter. To be honest, they have certain levels of them too that you can buy, so you can get more complex ones. It's just going to be more expensive, and sometimes, depending on if you use the really expensive ones, it can be just as much as just paying somebody to do it for you. So just be aware of that. But you know what though? They're all the same. They all do the same thing. It's just the way that you input's going to be different, and so you can't go wrong either way. The free ones, though, I will tell you that as soon as you start getting moving parts, they won't be able to handle it. So you'll have to go to H&R Block or TurboTax. And sometimes those can't handle it, in which case you'd have to go to somebody like me.
All right, great. All right, so let's say a 1099 income is a side hustle.
Okay.
So it's actually, they're a W-2 choir teacher.
Okay.
But they also have a gig as a singer.
Mm-hmm.
And that's where their 1099 income comes from. Can I avoid estimated quarterly payments by just having higher withholdings on my day job?
Yes, absolutely. The estimated tax payments are really just kind of for those who don't want to change withholding and need to make additional payments throughout the year. If you compensate, so a good rule of thumb is, let's say all of a sudden you have estimated tax payment vouchers and there's a specific dollar threshold that all of those combined. If you can get that amount into your withholding in your W-2, it's essentially doing the same thing. And so you don't have to pay those if you can adjust your withholding to maximize that. Just know that sometimes, adjusting your withholding is difficult depending on who your payroll provider is. And so you may have to resort to the estimated payments to make that work.
There's a whole new process for doing
Oh
payroll.
God, yes. The
It's such
W-4 is like a
pain.
tax return. It's
It's
dumb.
ridiculous.
Yeah.
I couldn't believe it when I looked at it.
Yeah.
Do the penalties related to not paying estimated quarterly taxes for 1099 income start the first year of business?
I'm assuming it's like, let's say we started on 1/1/20 and you started the business and you see this income. Yes, it does count. And so that's the frustrating part, is it's kind of a moving target throughout your whole year. It will, if you have a liability that's higher than $1,000 and you had a side hustle that was making that kind of money, they will kick in. And so if you know that you are making substantial money, I would strongly suggest you make some sort of estimated tax payments to mitigate those penalties and interest. It's not a lot of penalties and interest depending on how much your liability is, but if you have a high enough one, it can be a lot. If it's low, it's going to be a couple dollars. If it's higher, it could be a couple $100s. And so that's something you want to avoid just by paying in throughout the year.
Okay, I'm going to do just a couple more questions and we're
Sure.
going to wrap this up. I had several expenses back in January that could be considered business expenses. 1099 contractor. Before I actually started my job this month. One thing I had to pay for was my provisional license. Can I claim that retroactively? So basically, didn't start receiving revenue till this month, but started working and opening the business in January.
Yes, you can. So what they call those are startup expenditures. There's a certain amount that you can deduct through amortization, which is like depreciation. So what happens is you capitalize you basically create those startups costs as an asset, and then you amortize it and yeah, this is where if you have those, you probably want to come find somebody like me because they'll be able to handle that for you, but you will get some benefit, but it's over a course of years. It's not in the immediate year. And so, yes, if you have those, find somebody like me to help you out with that, because that's something that I doubt TurboTax could probably handle, or H&R Block. Well, H&R Block probably could if you went in, but TurboTax software probably not.
Okay, I'm going to do one final question.
Sure.
We have 3 Roth questions that are a little complicated. I really apologize because I want to get to them, but I think they're just going to take too much time, and we need to wrap up here. So we might take a screenshot here. We can answer these on Thursday at the office hours. So hello, I'm a newly sorry, I didn't need to put the hello in there. I'm a newly graduated SLP working as a 1099 contractor in Florida. I am constantly bugging my accountant about what things I should be counting as business expenses. Are there any resources, rules, or hacks for learning what things to count? Can you point this individual to some resources that they can help figure this out?
I believe I put it in the resource on the back end of the presentation. I put some resources in there to show what it is. If not, a great way to figure out what expenses are eligible based on the IRS guidelines, since you have no state income tax in Florida. Google ordinary and necessary business expenses, and it should bring up the IRS website, which will tell you how to figure out if it's ordinary or necessary. First of all, you shouldn't have to be bugging your accountant to figure that out, because he should be helping with you that in the first place. But it's one of those things where if it's ordinary in the course of business for everybody else, meaning this legal pad, if you're taking notes, I'm assuming everybody has something like this or an electronic version to use taking notes when you're doing your sessions, right? That would be ordinary and necessary. One that's kind of can be, it really just has to think about, am I using this in everyday business? So for this laptop that I'm doing this presentation on, this would be ordinary and necessary for me. If you have a laptop that you're using, it would be ordinary and necessary for you to be able to do your job. So just keep that in mind, that if you look around to other SLPs and you're like, okay, well, that person is using, I don't know, a cell phone that you can talk into to dictate notes or whatever, that would probably be ordinary and necessary. The person that rolls up in a Porsche, I would imagine that's not necessary for your business. And so that would be probably a red flag. So ordinary and necessary in the course of business that other people would use at the same time. So other SLPs would be using it. But yes, Google it. IRS will show you how to determine whether it's ordinary or not. And then use that as a template to kind of gather your expenses. A great way to kind of gather them is either maybe QuickBooks if you have a lot of transactions, or a spreadsheet is a good way to do it too.
All right. Wow, Dan, you're going to need a glass of water or a beer
I got
after
this.
this.
I have this Mountain Valley water that I've been drinking this whole time. So.
All right.
Yeah.
Man, well, just want to again say thank you so much for all of the information you provided and answering the questions. As we begin the tax season here,
Sure.
there's a lot to know. We really appreciate you being on. I'm going to hand it back to Dan Otter, but thank you, Dan Herron. Really appreciate it.
Thanks, guys. Thank you for attending. It was great fun.
Yeah, Dan, I echo what Scott said. You were amazing. Thank you so much. And we also appreciate your generous offer to come back and do an office hours, and then also do a withdrawal strategy from the tax perspective. So thank you again so much, Dan. Thank you, everyone, for joining us. We hope to see you at a future event.